Ahead this morning, Julia, JB Hi-Fi shares.
Brooke, some of the commentary that has come out from JB Hi-Fi has been extremely positive, especially around January trading conditions, where we've seen total sales rising by 11.7%, and from a like-for-like basis or a comparable basis, a rise of 4.2%. So that commentary is extremely positive in regards to the second half of the year. If we have a look at the actual result coming through from JB Hi-Fi, it came in at $82 million, beating our expectations of $79 million. So that was a positive. Remember, this is a stock that's underperformed the other retailers. Over the past year, we've seen the stock down by around about 8%. And in 2013, it's been trailing the likes of Myer and Billabong that have been performing quite well. If we have a look at the profit result, we saw an increase of 3%. Sales were up by 3.1% on a total basis, but on a comparable basis, we actually saw a fall of 3.5%. And this really indicates that the growth that we are seeing in sales is being driven by the aggressive store rollout that JB Hi-Fi is doing. It's planning on 15 stores in the full year. It managed 11 in the first half of the year. So the fact that we are seeing new stores is helping that total sales number, but still not helping on a comparable basis. On a like-for-like comparable basis, that decline of 3.5% was mostly due to the visual division. If we have a look at visual, that was responsible for 85% of the decline in comparable sales. In fact, if you strip out the visual division, which of course includes televisions, then we only saw a decline of 0.6% there. The good news is that JB Hi-Fi in the last 18 months has been under a whole lot of price deflation because a lot of its competitors like Dick Smith have been clearing stock. Now there are signs now that this is easing. We have seen gross margins actually rising by 28 basis points. So I think that's going to be seen as a huge positive for the market, that we are seeing these cutthroat prices, the conditions there just easing up. In fact, in Australia, we saw the gross margin increasing by 25 basis points, and importantly, online sales growing quite aggressively. Of course, it is off a small base, but up by 40%. The January outlook, the January numbers were quite positive, but I guess what's interesting is the full year outlook now. JB Hi-Fi saying that they do expect full year sales of $3.25 billion. That's slightly lower than the original August forecast at $3.3 billion. Net profit is expected to grow by 3 to 7%, so that's a positive there. But in terms of comparable sales, they are expecting it and basing it on a loss of 3% or a decline of 3%, and previously they had been forecasting a decline of 1%. So the outlook statement a little bit mixed, but the fact that we have seen a very strong month in January, a positive sign for JB Hi-Fi, and this half year numbers beating.
Well, indeed, the shares out of the gate spiking 10%, now in that 12% positive zone. Just put it into context with some of the other stocks that play in the space. Just noticing already today, Super Retail Group cut to sell from neutral. So, tale of two different stories playing out in the space.
Absolutely, but the Super Retail has been doing extremely well, and I think the basis behind that cut would probably be on a valuation basis. The thing in this market is now we have seen stocks running extremely hard, and Super Retail is one of them that's been doing so well. So on a valuation basis, it is looking expensive, even though its underlying business is looking quite attractive. So a number of companies being cut in terms of their broker ratings at the moment, not because their business isn't doing well, but just because they've run so hard. We've seen stocks like Seven West Media up by a massive 40% in 2013 so far. If you have a look at stocks like Billabong, Pacific Brands, these are stocks up by around about that 20% mark, as is David Jones. This is in just over a little over a month. So we have seen stocks running hard, and we're now seeing brokers adjusting their 12-month targets and their recommendations on the stocks on the basis of these prices. So it's not necessarily...
Well, I was going to say, on price earnings multiple levels, therefore, does that make CBA perhaps the most vulnerable to fall quite sizably if it's not a shoot the lights out come Wednesday?
The banks are an interesting one because I really don't think it's been earnings which has been driving the share price appreciation that we've seen in the banks. We have a look at expectations for earning growth for the banks in FY13. It's for growth of just 1.4%. That's anemic. That doesn't even come up to inflation. What's been driving the banks is the very strong yield that they have, the fact that we've seen interest rates falling so aggressively here in Australia, and the fact that the banks have a very strong yield. So I guess the profit result is important because longer term we need to see some earnings earnings support the valuation. CBA is looking expensive. However, I think the market's going to be more interested in how much that dividend rises, because that's been the key behind the banks running so hard. It hasn't been enormous earnings growth. We haven't seen 10-20% earnings growth coming out of these banks. Expectations are very low in terms of earnings, but it's really been that very strong dividend yield, the franking credits which are attached to that. We know that CBA goes ex-dividend in February, so we'll be watching that dividend announcement very closely, and I suspect that may be even more important than the earnings announcement. The earnings probably will come in line with expectations. Our expectations is to see a half-year cash profit of $3.6 billion. So as long as it's not too far off the mark, I think it's going to be the dividend announcement that the market is watching for, although the outlook statement also important.
Julia, are there other results this week that will really help to answer the question about whether this market's gone too far too fast in terms of specific companies coming out?
I guess in terms of company earnings, expectations are pretty low for the full year. We're expecting to see about 3% growth, and that's consensus. That's down from about 10% about 6 months ago. So expectations are low. However, one of the things that we may see is a hit to investor sentiment. The expectation is that FY13, the current financial year, will be quite low in terms of earnings, and that we'll see a bounce back in the cyclical conditions in the next financial year. However, we've seen from stocks like Cochlear that if we do see a miss, that stocks can be quite rapidly and quite a big change in terms of share price. So we may see a shift in investors moving back to those companies and stocks which have a very clear earnings growth profile. So either growing earnings now, or there is a very clear path that can be seen towards that earnings growth. This week is going to be a huge one. As I mentioned, Commonwealth Bank coming out with its half-year result on Wednesday. ANZ will also be in focus on Friday with its quarterly trading update and its interest rate announcement as well. We've already seen the retailers kicking off with JB Hi-Fi's half-year profit result today. We'll also see Billabong on Wednesday, and David Jones will come out with its second quarter sales number. A big one on Thursday where we see Rio Tinto coming out with its full-year numbers. We're expecting to see $9.2 billion there. No huge surprises given that we've already seen the production numbers coming out of Rio Tinto, but watching for more news of the write-downs that we already heard in the last announcement. So a huge week in terms of the Australian share market, in terms of earnings, but in terms of global leads, it's going to be a pretty quiet one. We see both Japan as well as China closed for that Lunar New Year. In fact, China closed for the whole week, so we're expecting to be a quiet market around the region.